You might be able to get a good deal when it comes to these large multifamilies, but everybody, you can't, it's like a double-edged sword. You can't say, oh, I want to raise all my rents, but I want AAA financing right away. Like that doesn't work. And this is how we're going to show you how to get to where you got to go. The idea here is not only are you getting your $138,000, you now have a positive cash flowing property of $27,897 per year.
What is up, YouTube? Matt McKeever here, and in today's video we're going to be talking about BRRRRing apartment buildings. Two of my favorite subject matters, BRRRRs and apartment buildings. Today Josh and Ehren are going to break down for you the exact finances behind an actual project that they're financing right now for one of their clients. Again, if you guys don't know, Josh and Ehren are local mortgage experts. Let's jump into it. What is up, YouTube? Matt McKeever here, and we've got Josh and Ehren from the Findlay Mortgage Team again. Hey guys, how's it going?
Good, man, good.
So you guys probably are noticing something a little bit different. We decided to mix it up on today's show, and they're actually going to break down for us an example deal. This essentially is kind of breaking down like a 22 unit typical deal you might see in Windsor, Ontario that has a big value add. And we've noticed that a lot of people are enjoying the information oriented videos we're doing, but we also know you guys, there's at least a subsegment of my audience that are huge numbers nerds. So we're really going to dive into the numbers in today's video. I'm really excited that we could just break down this example, because I think this is the sort of deal a lot of my viewers, either today, tomorrow, or like in the next 5 years, they want to be able to get into these sort of deals. So what are we looking at here, guys?
Yeah, so this is it's based on a real life example, but has been changed a little bit just for the purposes of this. Be generous with us a little bit. This is a pretty generic example. We are doing the final valuations based on a pretty 6.5% cap rate, just to keep it as general as possible. But again, just to give you guys an example of the cost getting in to a building that is underperforming, and then what the potential could look like once it's maximized value, all the rooms are rented out, and it's cash flowing back to normal. So this initial section here on the left, these are the numbers as is, as listed upon purchase. And then the numbers over on the left there with Josh, or you're right, I guess, or Josh, are what the numbers are going to be after you've gotten in, you've done a little bit of your renovations, and you've had some tenants come in and fill the vacancy. So on this initial side here on the left, there is about 6 or 7 vacancies, I believe, in this building that we had looked at. So I'll break down the numbers here for you. So the purchase price was about $2.8 million. If you were looking to get a 75% commercial mortgage with like a credit union, the first position mortgage that you'd be asking is $2.1 million. The general revenue, so gross revenue on this building, was $157,724. Utilities were $18,741. The insurance, $6,543. Property taxes, about $32,000, so like $31,898. The vacancy and the management / maintenance, both of these are 5% values off of the gross revenue. So we're using $7,888 for both of these two values here. Net income, after taking a look at the expenses, $84,765, and a mortgage payment. So this mortgage payment that we derived is obviously annual. This was off a 3.5% commercial rate at a 25-year amortization. So this is going to be pretty much your standard credit union purchase. Now, if we run these numbers here, your DSCR here, so this is basically your debt service coverage ratio, a big key factor that the commercial lenders are looking at. They want to see something around 1.2 to 1.25 for them to really have some extreme interest in it. As you can see here, we're looking at 0.63. So, pretty underperforming currently. As expected, you got about 6 or 7 vacancies in the building. It's not going to be performing at 100%.
And so that's going to result obviously in currently negative cash flow. Yep. And one thing to really point out that I think a lot of new buyers into larger multifamily get tripped up on, we have to use actual revenues, not pro forma, right? So even though I could rent out maybe those apartments for $1,000 a month each, I'm not going to be able to immediately just juice up my returns here, right?
And that really is the difference between buying something that hits value and it doesn't hit value. People come to us saying, this great property, but it's not renting out. And all of our lenders are going to us and saying, that's great, close privately, rent it out, and show us that it's rented out, and we have no problem giving it to you. But we can't hypothecate 6 vacancies because you're not making that revenue. And that's a make or break for all the banks, especially when it comes to large purchases like this. So, you might be able to get a good deal when it comes to these large multifamilies, but you can't, it's like a double-edged sword. You can't say, oh, I want to raise all my rents, but I want AAA financing right away. Like that doesn't work. And this is how we're going to show you how to get to where you got to go. So the idea here is, we have your acquisition costs. These are hypothecated. Obviously, some of these numbers can change, as Ehren said. We have a 2% lender fee, 2% broker fee. We're hypothecating here that you had purchased it privately because it was undervalued. Under rented with a DSCR. So we got a phase one, a building condition report, and an appraisal. We estimate around $2,500 for each. We have about $100,000 renovations costs. We're going to say that you guys are going to take advantage of these 6 vacancies and throw some money in there and fix them up so you can rent them out for a little bit higher than what the other tenants are currently renting out for. You don't want to miss out on an opportunity of being able to raise that rent. So what's going to happen is, as soon as you're done all those renovations, you're going to refinance it, and you're going to refinance it with a lender or a credit union in this case. So we're going to hypothecate that it's going to be either a broker fee or a lender fee, total of 1%. So we got a $24,675 broker fee. We got around $5,000 for legals, and this lender is going to require that you have a new appraisal based off of the fully tenanted property at $2,500. That gives you a total refinance cost of $32,175. Now, these are the refinance numbers. So the value here, as Ehren said, I believe we used a 6.5% cap rate. So based off of the net operating income of the property after you had rented out those 6 units and done those renovations, that's the new value, $3.27 million. You're going to want to get 75% loan to value on that to be able to pull your cash out, to be able to reinvest it in other things. So we got a total mortgage here of $2,467,500. Your revenue is $258,792. As you can see, it's drastically different than what your revenue was.
Well, about $100,000 difference, though.
All right, so your utilities, insurance, and property taxes are all going to stay the same. Now, your vacancy and your management fees scale up as your revenue increases. So if you got 5% and you're going off 5% baseline, we're going to base that off your revenue. So as you can see, it changed from $7,888 to $12,939. Your net income here is going to be $175,731. Your mortgage payment, we have $147,834. This gives you your DSCR of 1.19%. Now, most of our lenders are 1.2. If you're at 1.19, we can push it through and make an exception here. Now, as you can see, not only are you pulling cash out and creating value, so if you look right here, your total equity takeout after all your expenses is going to be $138,825. That is cash in your pocket after cost. Not only are you getting your $138,000, you now have a positive cash flowing property of $27,897 per year. So you can take that cash, you can go reinvest it, and you have reoccurring passive income through your active BRRRR now.
Yeah, we did this as kind of like a worst case type scenario where you had to get in private. You're using a lender or obviously a lender, but you're also using a broker. So we added in both the costs there, basically as high as an expense that you could get without possibly needing like maybe a phase 2. Just to give you guys an idea of the cost. Of course, renovations could change up or down, but again, looking at, you have about $140,000 to play with. So even if you wanted to up that to $150,000, again, you're still bringing in about $90,000 of income and that passive cash flow. So there are scenarios it can change. There are some other options that you could utilize to get in other than a private mortgage. Some of the credit unions that we work with do actually allow for vendor takebacks. So if you had a 25% vendor takeback, or you were able to negotiate a 50% vendor takeback, you can scale the loan down, which means your mortgage payment is going to be cheaper, which means your DSCR is going up because you have less liabilities. If you were able to, again, scale down that loan to value, you could potentially get into a credit union at 50 to 60% loan to value, make it cash flow, and go on that route. We just wanted to show kind of a worst case scenario you had to get in privately.
And worst case scenario, you're making a ton of money and you have a cash flowing property. Yeah. Thoughts, feelings, emotions?
Yeah, guys, so I'm hoping you enjoyed this more tactical, like deep into the numbers approach to breaking down the impacts when it comes to financing your larger multifamily properties. If you guys have any questions on this video, feel free to jump in the comment section, hit us up. Josh and Ehren are pretty good at checking the comments. And again, let us know, would you like us to do more numbers analysis like this? Would you like the guys, they've got a lot of clients doing this on a regular basis. Should they maybe be interviewing some of their clients? Let us know in the comment section down below. We're always interested in getting your feedback, and otherwise just really appreciate the deep dive into the numbers.
Yeah, thanks. We really appreciate you having us on. We're looking forward to doing more of these.
Let's do it. All right, I know there's a lot of numbers in that video, and I really appreciate Josh and Ehren breaking it down for us. But if you guys have any questions, jump in the comment section. Reminder, in the video description is all their contact information. So if you guys want to reach out or book a call with the guys, you can actually do that as well. They're who we turn to when we're looking to finance a lot of our deals as well. So really want to encourage you guys to reach out to Josh and Ehren. But otherwise, every Sunday at 6 p.m., they're going live on their own YouTube channel. There'll be a link in the description. You can jump over. If you guys enjoyed this video, smash the like button, hit subscribe if you're new to my channel. I'll see you in the next video.